Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by David Broomfield. Hello, David. How are you?
Hello, I'm good, thank you.
Good. Now, what are we going to do today? We're going to do the quick fire numbers round in a minute, but we're doing a bit of a recap on 2024 this week, aren't we?
I think we should. It's been a remarkable year. I think you could have predicted a number of the trends, but some of the detail, I think, perhaps is more difficult, which is, I suppose, when you're an investor is the point. You need optionality in your ideas. You need ideas that work with the trend, but also if that perhaps the outcome is slightly divergent. So yeah, we've got to do a recap of 2024. So much has happened.
Okay, right. But before we get to that, quick fire numbers round. Do you want to go first, David?
I will. I'm planning on winning the quick fire numbers round competition this year.
It's not a competition, David.
Well, I've got the biggest number. Okay, so my number this week is 1,618,840,606.
Right. Okay. Well, if we were just going purely on size, you're the winner. What does that number represent?
And it's accurate down to the last digit. It is from the International Institute of Democracy and Electoral Assistance, which is an intergovernmental organization that supports democracy worldwide. That is the number of ballots that were cast this year in elections, in the 71 elections in democracies that have happened so far, with a few more to play for. 74 elections this year, 3 remain. And one of those might even roll into next year. Do you want to guess on the countries, or do you want me to tell you?
No, you're going to have to tell me.
Okay,
lost track.
3 that remain are Chad, Guinea-Bissau, and Croatia.
Right. Okay. I'm glad I didn't try and guess those because I would have not had a chance. Okay. Well, that's a really good number, and it kind of relates to one of our themes today, doesn't it? Because 2024 was always touted as the year for elections. So we'll come back to that. Okay.
What's your number?
My number is 37%.
Okay, go on then. I have no idea.
That is the percentage in the UK of 25 to 65-year-olds in employment, not self-employed, but in full-time employment, who report having a higher qualification than their job requires. So essentially, overqualified workers in Britain, roughly 37% of the workforce. Now, the last time they did the survey was in 2012, because they only do it once every 10 years. And it was 30% then. So an interesting fact, and also it does mean that they tend to be underpaid, those people who are overqualified. And it is the highest percentage of advanced economies in the OECD.
Wow. And that's people recognizing that inequality in themselves, is it?
Yeah. I'm doing a job, and my qualifications would actually make me or a fit for a job more senior than the one I'm doing. I wonder how
that survey will change over the next few years with AI as this existential threat to all these highly qualified white collar workers.
Yeah, I read that 60% of adults in the UK have a degree, or young adults, I should say, which is one of the highest in the world.
Yeah, good. I mean, we all know that. Yeah, that was that statistic turned quite markedly from the late 90s onwards. Incredible, great number.
Oh, small but good. All right then. Okay, so let's. What do we want to talk about then? We're going to do a little bit of a recap, but then we're going to do a bit of a deeper dive into a couple of themes. So, what do we want to? How are we going to break this down into our sort of 3 topics?
Well, the first one we touched on, didn't we? The recap of 2024. There's been a few standout trends this year that we should talk about. So obviously there's American exceptionalism, and we can contrast that with Europe. We've got the various trades that have gone bananas. Gold's gone bananas, Bitcoin's gone bananas, and even bananas have gone bananas, as we discussed last week when we talked about the $6.3 million banana. So we should talk about equities, obviously, but then there's this idea of inflation persistence, and I want to touch a little bit on what central banks have done, and I'll be a little bit cheeky and just remind everyone of my question of whether central banks perhaps are as omnipotent or omniscient as they claim to be. And so we'll talk a bit about what happened in 2024, and then that leads us into our second topic, I think, which is also relating to what happened in 2024, the shift in elections and geopolitics and the bearing that might have on next year and going forward, because obviously inauguration day is 20th of January. I know that because that is the day that I started at Coutts over a decade ago. And it's also my wife's birthday. So it's an easy date to remember.
Important date.
And then the third point, I think, is the Trump trade, because we talked about that last week. And let's have a little chat about that, because remember, we've got the Trump 1.0 playbook from back in 2016, and we can contrast that perhaps with the 2.0 playbook for next year and beyond. Okay.
All right. Well, let's kick off then with US exceptionalism. Explain what you mean by that, first of all.
Well, really, it's about the ability of the US equity indices to generate just consistent, and the word is consistent. It's not necessarily higher, although it has been markedly higher recently, consistent earnings growth year on year on year. And it stands out. And I think if I think about the key trends this year that we as a team at Coutts anticipated, American exceptionalism is one of those. And that's been the standout story. I mean, those US earnings have been well signposted. And that contrasts, I think, with a much different economic situation in the European Union.
How much of that is US exceptionalism and how much of that is tech exceptionalism?
It's a good point. I mean, look, you can do, I'm going to say naughty things with indices by let's say I remove NVIDIA from the S&P 500, and does the US look exceptional compared to Europe? Well, the answer is no, but that's not the point. If you remove the top performer from the US and the top performer from from a European index,
okay, fair point.
The US still outperforms. So yes, tech has been very much the story of that exceptionalism late 23 into 24, but the story is not just tech. I mean, it's broadened out massively, and we're in a stage of the cycle where everyone recognizes that equities are expensive, but also doesn't really mind that they're expensive because they're being supported by this earnings growth. And while corporate debt spreads are remarkably benign, even borrowing costs for these firms is still pretty low by historic standards. So at this stage in the cycle, I think everyone is looking at the valuations, they're seeing them and saying, well, growth is still strong. And it's broad as well. It's not just tech.
Yeah, it's definitely broadening out from where it was, I guess, at the start of the year, isn't it?
Exactly. And you contrast that with the European economic situation, which has actually played out kind of as you would predict. And so much of what happens in Europe now, unfortunately, is basically weather dependent, because energy costs, particularly as we go into winter, become immediately very high profile, very high on the agenda. And you've also had these self-imposed regulatory constraints, self-imposed fiscal constraints in the case of Germany. In fact, I just posted today on LinkedIn a chart showing perhaps there's going to be a shift in orthodoxy in Germany with respect to the fiscal regime that they've been under certainly since Merkel in 2009, where you might see some of what Draghi refers to in his report, the report that we discussed.
We talked about that,
that requires perhaps borrowing for investment. So Europe is a stark contrast, I think, to America. And then, of course, the things that went bananas, gold, which this goes back to my point on when you're an investor, you need optionality. Gold, I think, was an interesting hedge against upside inflation risks in late 2023. And as it turns out, okay, inflation has been sticky, but the probability, the chances now of getting a renewed inflationary impulse driven through excess sort of wage growth is now much, much, much lower than many people think. So gold, wasn't really a hedge against inflation. It wasn't a hedge you needed against upside inflation, but it was driven by the mechanism that played out in China, where banking system stress and geopolitical tensions drove everyone, and including the central banks, in this kind of two-pronged demand surge for gold. So it's different factors have driven the gold price perhaps than we anticipated, but gold did incredibly well this year. And then obviously you've got Bitcoin and the banana as well.
Yeah, I mean, Bitcoin, well, last time, I mean, forgive me because I've been on leave, so I haven't sort of been so assiduously reading the financial press. But Bitcoin did get up to $100,000, didn't it? I don't know where it is at the moment, but it just seems to keep reaching new highs without any, as we've discussed numerous times, without really anything fundamental to to back that up? It's purely emotion, purely sentiment.
Yeah, so it's above $100,000 as we record this, just flirting above $100,000. But I would say, and I don't want to spend the rest of the pod talking about what is driving this recent surge, but for those that are interested, can look at MicroStrategy's approach to holding Bitcoin on its balance sheet, where effectively it's using these structures called convertibles to give investors access to Bitcoin in a derivative construct that as a retail investor, you would never be able to invest in, right? So by buying the share of the company that holds Bitcoin on its balance sheet, you can have effectively a leveraged play against future Bitcoin appreciation, okay?
That sounds like a risky strategy.
It's what colloquially is known as financial engineering, and it works as long as the price of Bitcoin keeps going up over the next 5 years. Now, it has, if you look at it point to point, it has gone up over the last 5 years, point to point. I mean, my word, there's been some oscillations.
Yeah.
I would just say that you can go down a huge rabbit hole reading about this. It's basically a form of regulatory arbitrage because retail investors should not be investing in derivatives, certainly not Bitcoin ones. And that's what buying that equity effectively allows you to do. So yeah, I mean, as I said, I'm not going to spend the next 40 minutes talking about that. No. But it's a really interesting read for those that want to go down a rabbit hole and look at it.
Okay, so we had gold, Bitcoin, and bananas all going bananas in 2024. The other thing then was rate cuts and inflation and that whole narrative. Now, we ended last year, 2023, with the Fed pivot. Everybody got very, very excited. We're going to have lots of rate cuts in 2024. They didn't materialize. I mean, we might still have one more this year. We've only had two. Admittedly, one of them was a double, a 50 basis point cut from the Fed. But what happened?
Yeah, so you had quick, for those that for some reason don't remember, you had inflation hitting that multi-decade high around summer 2022 into 2023. And then it began to ease significantly. So if you think of United States headline inflation, you had it dropping year on year from about 9% in late 2022 to around 4% by early 2024. So you had this rapid disinflation, and that was driven largely by external factors. Okay, so you had stabilization in global energy, you had resolution of supply chain disruptions. These are all things to remember. Winter of 2022 is a pretty bleak winter, with supply chains having to rewire themselves, and obviously energy markets unable to cope with what was going on at a geopolitical level. So a lot of those external factors, those trends played out. And this goes back to my point about being on team transitory. We had a big inflation shock and it worked its way out of the system. But in 2024, you had this remarkably uneven sort of, sticky trend in inflation. Like if you look at core inflation, excluding food and energy, it declined at a much slower pace, I think, than people were expecting. And that's actually not uncommon. If you go and look at history, chaos arrives quickly and leaves slowly. But I think despite the history lesson, a lot of people anticipated more rate cuts quicker than actually happened.
And in fact, the latest US CPI that came out recently, that did tick up very slightly, didn't it? 2.7% up from 2.6% in October.
It did, and we discussed that a lot last week, didn't we? And some of those are features of lagging indicators. I mean, there are some sticky components, right? Whether it's insurance or certain rental contributions to that index that perhaps don't reflect real live sort of rental costs. So there's a bit of a lagging component, and it is lumpy. So we shouldn't get too hung up on a month-on-month print. The overall trend is still disinflation. So we had this sticky inflation throughout the year, and then central banks maintained basically tight monetary policies as a consequence, despite that visible decline in inflation that you had since mid-2022, late 2022. As the year progressed, obviously, then we started to see the adjusting of the approach, which really came to a head, I think, late summer. And you saw that improving inflation data. So, you had the Fed cuts in September, November, and we've got an anticipated one next week, where we could bring the rate, the Fed rate down to somewhere around sort of 4.25% to 4.5%. Equally, the ECB moved sooner because disinflation is alive and kicking in Europe. I mean, it's remarkably alive and kicking. If you go and look at a similar chart to the US in Europe, it shows that it's firmly in disinflation right now. Energy is obviously the key variable in Europe. They don't have energy independency. They're not energy independent like the US are. So they still suffer massively when you see, global energy costs rising, or if the weather gets cold. So the ECB started cutting in June, again September, and then October again. So the trend, we were right, but again, timing is critical here. And this goes to the point of the lesson, I think, that as we go into 2025, I think the outcome here is that inflation continues its downward trajectory. Core inflation is still dropping. Components are sticky, as we said, and central banks have been framing this as a successful soft landing. And that's helpful because there's no real accepted definition of what a soft landing is. But, labor markets have got the central banks out of a lot of trouble. They've remained strong, and basically we've avoided any kind of recession. I think I would say, just to conclude on this point, that much of the progress that's attributed to central banks is probably external factors like stabilizing energy prices, improved supply chains, rather than deliberate central bank policy. The timing of the rate cuts, I would suggest, are probably illustrate that point. They're probably a bit late, but let's see. We're still getting live prints of macro data coming out over the next couple of weeks that might prove me wrong.
And ultimately, because I would say markets got very excited at the end of last year when we had this Fed pivot, and Jerome Powell said that we'll start cutting rates before we get to 2%. But actually, we didn't then see a kind of a sort of a negative reaction when people started to cotton onto the fact that actually inflation is still sticky. The Fed is not going to be cutting perhaps with the pace that we anticipated. So it didn't really impact. We've seen it perhaps in bond markets, but we didn't see it in equity markets, did we?
No, and that goes back to that resilience of earnings growth. And I think that the greatest financial innovation over the last 30 years has been the fixed 30-year mortgage in America. It has termed out everyone's rate sensitivity. So I think that the lessons from me this year, right, are that the mechanics matter the most. Okay, so the strongest calls that we made as a team weren't just directionally correct, that they were based on a clear and tested framework and causal relationships, like US earnings as an example. Okay, that worked. I think the lesson that I suppose I would say from this year is that timing matters quite a lot. It's the hidden sort of enemy here. Okay, so I use the example of being right about nuclear power in 2011. It's clear that nuclear power is certainly a significant component to the challenge that we face with CO2, energy-related CO2 emissions. But to be right about it in 2011 doesn't necessarily make any money from the trade, right? Yeah. You might have to wait well over a decade for that to come true. Okay, if you don't want to wait a decade, take the Novo Nordisk story about weight loss drugs that have come out, and you've seen that stock rise massively on the basis of these GLP-1 drugs, and then sell off quite significantly since. So the directional call isn't enough. You've got to have sort of quantifiable benchmarks to be able to kind of make these sort of predictions. Okay, I think always investing in line with any kind of legislative change or regulatory change, which is why we tell people not to invest in line with elections and electoral cycles. It doesn't work because the logic is wrong. You're just trying to squeeze sort of complex institutional changes into really arbitrary time periods. And some of those changes will take years or decades to come through into earnings growth, into markets, which is why you focus on markets. And then the third lesson is the one I mentioned earlier, which is about optionality. So take my gold example. The best themes, as we go into 2025 and we all start thinking about themes for next year, the best themes are going to be ones that aren't driven by a single point, but the thesis can come true with multiple different pathways. Yeah. Okay. Yeah. So take my gold example. There were lots of reasons why gold might have rallied this year. You didn't have to bet on just one reason. It's about building in multiple ways to win, I think.
Okay, that makes sense. All right, then. That brings us then to the second point, which was elections/geopolitics, because 2024 was touted as, and as your incredible number, which don't ask me to repeat it because I can't remember it, but it was billions. The number of people that went to the polls in 2024, and as you said, 3 elections still outstanding. It's been the biggest year for democracy since I don't know when. Something like half the world's population voted this year. Obviously, the main focus was on US elections and on, from our point of view, as people that live in the UK elections. But I guess it was touted as the big theme, but it didn't really have a huge impact on markets, did it?
No, not at all. I think the point here, which we've expressed a number of times this year, is that elections over the short term don't tend to matter. I mean, my point that I just made a moment ago, that don't try and predict the impact of regulatory changes or legislative changes and put them into some arbitrary time box to make a trade seem like it's a good idea, because that time box is probably over years or decades, which is why in the short term the market impact is entirely negligible. If anything, it's just a source of short-term volatility potentially.
Yeah.
And I think that, the number, you're right. I mean, about half the world's population, I think, were in countries where there were an election. I mean, the number that I provided at the beginning of the pod was based on how many then actually voted, which is clearly a lot less than half of the world's population. So I think what's interesting, I think, is actually events over the last few weeks. And we talked a little bit about South Korea in the intro to the pod last week, and this idea that the world is in absolute chaos and democracies are collapsing. I think South Korea showed that actually, no, that's not the case, that actually democracies are still alive and they're different. Certainly, we're moving into a whole different regime for democracies. But if you look at what happened in South Korea, where the parliament basically rushed and rallied and reaffirmed their democracy within about 6 hours. I mean, if you could easily have slept through that and not known that anything had happened. And I think that actually that there isn't as much there are things to worry about. Democracies are never just given or certainties. You always have to worry about democracies, and you always have had to worry about democracies. But I think that South Korea does show that they are still alive and kicking. And I think obviously there's no French Prime Minister anymore since we spoke last time. And we don't know yet still how that's going to be resolved. But I think I wouldn't worry there either. I don't think there's a constitutional crisis in France because, Germany effectively doesn't have a government, and Belgium didn't have a government for over a year. And during, I think, the Olympics, there for about 60 days that France didn't have a government as well. So, democracies and governments tend to muddle through. And there will be challenges next year, potentially. It wouldn't be a year in politics if we didn't talk about a government shutdown somewhere in the world. The point is that we're remarkably good at muddling through.
I guess the two wild cards potentially for next year are, and I guess will depend a little bit on the new president in the US, is what happens in Ukraine, whether there's some sort of agreement there or a conclusion to that conflict. And I guess the Middle East as well, with what's been happening in recent news with Syria. And those are potential that they're going to play on into 2025, aren't they? And could have an impact. I guess one argument for a resolution in Ukraine is it would be good for Europe and certainly for European markets, wouldn't it?
Yeah. I mean, I think that one's just so difficult to forecast. The energy infrastructure, obviously, then the commodity market implications are the easiest ones, I think, to diagnose. Then you have infrastructure, rebuilding costs. There's a very complex knot to unpick there. I wouldn't make such a bold claim. I think. I mean, I think that for me, the implications of geopolitics this year come down to the US election result. Okay, and we're going to be debating on the pod some potential for domestic policy shifts in the US, and then the global economic impact of those. So, there are key debates going on in the US at the moment about the future of federal spending, strategies to combat inflation, broader fiscal policy goals, and those outcomes will define the role of government intervention in managing economic challenges. And there's some obviously strong opposing views on what the right policy mix was post-COVID. And did the CHIPS Act and the IRA cause this big bout of inflation, and there's a lot of evidence that suggests that's the case. So I think that it'll be interesting to see how this incoming administration deals with that, because that obviously has a global ramifications. And equally, the same while we're talking about domestic policy, energy and infrastructure. US energy policy is probably a crossroads right now, because you've got commitments, obviously, to reducing fossil fuel industries and climate and commitments to climate change. And then you've obviously got what's been said on the campaign trail, which is about effectively increased resource extraction.
And obviously AI as well. We talked about the energy use of AI and water use of AI, and that as that grows and becomes ever more important, that's going to be another big factor, isn't it?
Yeah, massively. And the US is very clear that it sees itself as the global leader in this space, and the geopolitical tensions around the chip supply chains and how that plays out. I mean, there's some interesting threads people can read on gallium, which is a key component in chip making, and what happens in the commodity markets with gallium every time it's used as effectively a bargaining tool between China and the US. The commodity markets utterly go berserk, and this tiny little element, which is such a minuscule amount of is used in the chip making process, but it's absolutely critical to the chip making process. So we have all the geopolitical consequences of that foreign policy mix between the US and US-Asia relations to play out. Trade, security alliances, economic cooperation. There's going to be a lot to talk about next year in the whole international relations space. So I think that we can't predict any of this. And I think post January 20th, we'll know very quickly what's going to happen with trade. I think some of those tariff talks will either become real or be kicked down the road a bit further, and then we'll have to see what plays out after that.
Essentially, geopolitics is important every year, isn't it? It never goes away. The actors may change, but it's always going to be a key theme for markets for the year ahead.
Absolutely. I mean, this is evergreen topics. The world we're going into, though, we should recognise, and there has been a shift in regime. We had the period of globalization and global synchronous growth. Post-financial crisis, we were in this period of financial repression, but globalization muddled through. But we are entering a regime now, and I think now it's been a few years, we could probably say conclusively that we're entering into a regime where it's more complex than just increased globalization. It's a more uncertain world where supply chains aren't just unilaterally outsourced. Their resilience needs to be built into them.
Okay. All right, then. That's then our final point is you were going to do a little bit of homework on this, the Trump trade. Now, we talked about market reaction to elections, and certainly equity markets, or certain elements of equity markets, were very positive following the result of the US presidential elections. And there was this so-called Trump trade. And how well is it actually done just over 1 month down the line?
Yeah, so these are participants in the market that are ignoring everything I'm saying and actually trying to trade off a political outcome, which in the long term is not a good idea. Nonetheless, it happened before in 2016, and it happened again to an extent this year. And this is people taking an aggressive stance on tariffs and sweeping changes in particular sectors and particular companies. So for historical reference, in 2016, that Trump victory triggered a whole series of market movements. And it was this idea of deregulation and this pro-growth agenda. And if you actually look at the Sharpe ratio of the top 7 trades, risk-adjusted trades following Trump's win back there, you got very strong performance in small cap stocks, rising bond yields driven by basically expectations of increased nominal growth. You saw the US dollar strengthen, certainly against low yielding currencies that were going to be hit by tariffs. And then Bitcoin rallied as your deregulation friendly asset. If you compare 2024 to 2016, you've seen actually a milder market rally. Well, why is that? Okay, you got some valuation headwinds. Stocks are just more expensive than what they were in 2016. And then, if you're going to go long a particular sector, particularly like small cap, you're relying very heavily on earnings growth with, I would say, a less favorable backdrop than 2016, and it's marginally less favorable. I mean, there's still a lot. I think the point is that we are in a slowing phase of the growth cycle, even though it's positive. It's just difficult, I think, to take such a long view on small caps. And you've actually seen quite a subdued FX market reaction. So unlike 2016, you've seen the currency pairs like the Mexican peso, US dollar, with much less dramatic moves. So I think there's skepticism. This is my point that I've made on LinkedIn a few times, that I've got this obviously skepticism that many of these tariff gestures or bombastic claims are actually going to come through into policy. I think it's probably more likely a diluted version of that. And then Bitcoin as well. So obviously, I think that we talked about that enough. So I think we can just take that one as read. Macro conditions are probably the dominant factor here at the moment. And if you take a longer term outlook for the Trump's trades, you can look at each of those ones I mentioned. You tend to see the same pattern. You see the initial burst of enthusiasm tapers off. So you saw that with US banks and small caps post 2016. Again, you saw that with the currency and even with Bitcoin as well. I think the key differences this time, though, are that you could have broader macroeconomic trends affecting these trades. So in the near term, I would expect you've got this increased volatility, just as we try and understand whether aggressive tariff threats come true. You've got this volatile policy environment potentially, and you could see bonds do well if actually you get some weaker growth and if the Fed prioritizes economic stability over inflation. Again, these are all what ifs. We just don't know yet. But in the long term, and this is the point I think I'll probably want to conclude on with currency, you would say that the US dollar would be, based on history, potentially a good hedge against a turbulent environment, the one I just described, okay? Because we know...
It usually is, isn't it?
Yeah, exactly. We know this from the data. We know that the US dollar tends to appreciate in any kind of turbulence or crisis, even if that crisis is domestically US made. I think this is where I struggle with the contradictory rhetoric. So Trump has said a lot about he wants the US dollar to be a global currency reserve, and he wants to penalize anyone that tries to shift away from US dollars. And that is a narrative that would promote dollar strength. But his manufacturing electoral base doesn't want a strong dollar. They want a weaker dollar, because a weaker dollar obviously makes US exports more competitive. So I think it's going to be very interesting, I think, to see how this plays out. His new choice for Treasury Secretary, Scott Bessent, has obviously come up with his 3 threes, 3% budget deficits. He wants to go for 3% GDP growth achieved effectively through deregulation, and then wants to produce 3 million barrels of oil a day. And that, if you actually go into the CV, and this is good Christmas reading for anybody, go and look at where Scott Bessent sort of learned his trade. He is an expert through his trading activity in trading the yen carry trade and all things Japan, basically. So he has studied Japan in much detail, understands what yen weakness did, and the aggressive, easing measures that the Bank of Japan brought in to break Japan's deflationary cycle. And I think I always think at the back of my mind that you have a Treasury Secretary that has studied currency devaluation, and you have a president coming in that potentially wants a weaker dollar. So I think there's an alignment of interest there. But the implications for the dollar, I think, next year are going to be very interesting, because dollar strength is causing a number of problems, from inflation, export competitiveness around the world, particularly those countries that have had pegged exchange rates with the US have effectively had to take US monetary policy, which has not always been helpful for them. So I think for me next year, how the dollar plays out is going to be really, really important and really interesting. And the sustainability, I think, of the dollar strength lies a lot on the new Treasury Secretary and the future Trump agenda as well.
And we'll have to wait and see till after the 20th of January, when he's inaugurated, to see just how many of those policies that he's talked about in the run-up to the election actually materialise. and are actually sort of become fact, and how that then plays out in markets. So lots to watch next year. Plenty to keep us busy. Geopolitics, a new president, and probably more things going bananas, I expect.
Yeah, exactly. So remember my sort of 3 lessons about having a framework, creating some optionality in your trades, and also don't constrain your ideas to a particular time box, especially when it comes to geopolitics and politics, because these things play out over years or decades, not over months or even a year.
Yeah, brilliant. Thank you very much, David. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you for listening. Now, we've got a special episode next week. We're going to be joined by Amelie Serrado from Christie's, and as well as bananas, we're also going to be talking about generally the state of the art market in 2024 and perhaps some of the things we're going to be looking at in 2025 and how that's all developing. So that's going to be an interesting one. Until next time on Need to Know, bye for now.